Economic indicators are vital tools for understanding the health of an economy. They provide snapshots of various aspects of economic activity, offering clues about future trends. These indicators help policymakers, investors, and analysts to make informed decisions. Understanding these indicators can also help predict potential economic crashes. By monitoring changes in key economic measures, we can identify warning signs before a crisis unfolds. This proactive approach can mitigate damage and guide strategic responses. Real-world examples show the importance of these indicators. For instance, before the 2008 financial crisis, several indicators warned of trouble ahead. Those who heeded these signs could take steps to protect themselves. In this essay, we will explore the main economic indicators that signal a potential economic crash. We will explain each indicator, its importance, and how it helps in forecasting economic downturns. Gross Domestic Product, or GDP, measures the total value of goods and services produced in a country. It's a crucial indicator of economic health. A growing GDP signals a healthy economy, while a declining GDP can indicate trouble. When GDP declines for 2 consecutive quarters, it is referred to as a recession. Recessions often precede economic crashes. Therefore, monitoring GDP trends can provide early warnings of economic downturns. For example, the United States saw significant GDP declines before the Great Depression and the 2008 financial crisis. These declines were key indicators that the economy was in trouble. GDP growth rates also provide insights into the economy's momentum. A sharp drop in GDP growth can signal a potential crash, urging policymakers to take corrective actions. Inflation measures the rate at which prices for goods and services rise. The Consumer Price Index, or CPI, is a common tool for tracking inflation. While moderate inflation is normal, high inflation can erode purchasing power and destabilize the economy. Conversely, deflation, a decline in prices, can also be problematic. It often leads to reduced consumer spending, as people expect prices to fall further. This can slow economic growth and lead to a recession. For example, during the 1970s, the United States experienced high inflation, leading to stagflation, a combination of stagnation and inflation. This period was marked by economic instability and high unemployment. By tracking CPI and inflation rates, we can gauge economic stability. Sudden spikes or drops in inflation are red flags that can signal an impending economic crash. The unemployment rate measures the percentage of the labor force that is jobless but actively seeking employment. High unemployment rates can indicate economic distress and potential crashes. When people lose jobs, they cut back on spending, which reduces demand for goods and services. This can lead to further layoffs, creating a vicious cycle. High unemployment often leads to lower consumer confidence in spending. For instance, during the Great Recession, the United States unemployment rate soared, signaling deep economic troubles. This rise in unemployment was a precursor to the broader economic crash. Monitoring changes in the unemployment rate helps in assessing labor market health. A sudden increase in unemployment can be a warning sign of economic instability. Section 5. Interest rates and central bank policies steering the economy. Interest rates, controlled by central banks, influence borrowing and spending in the economy. Lower interest rates encourage borrowing and investment, while higher rates can slow down economic activity. Central banks use interest rates to manage economic stability. For example, during economic downturns, they often lower rates to stimulate growth. Conversely, they may raise rates to curb inflation during booms. Before the 2008 financial crisis, interest rates were kept low for an extended period. This led to excessive borrowing and risky investments, contributing to the housing bubble and subsequent crash. Thus, monitoring central bank policies and interest rates is crucial. Sudden changes or prolonged low rates can signal underlying economic issues that might lead to a crash. Section 6. Public debt and fiscal deficits. The weight of borrowing. Public debt and fiscal deficits are important indicators of a country's financial health. High levels of debt can strain government finances, leading to economic instability. When governments run large fiscal deficits, they borrow more, increasing public debt. This can lead to higher interest payments, reducing funds available for essential services and investments. Before the European debt crisis, countries like Greece accumulated massive public debt. This unsustainable borrowing led to severe economic crises and required international bailouts. Monitoring public debt levels and fiscal deficits helps in assessing economic sustainability. High and rising debt can be a precursor to financial crises, signaling the need for corrective measures. Section 7. Trade balance and current account global economic relationships. The trade balance measures the difference between a country's exports and imports. A trade deficit occurs when imports exceed exports, while a trade surplus occurs when exports exceed imports. Persistent trade deficits can be problematic. They indicate that a country is spending more on foreign goods than it earns from exports, leading to increased borrowing and debt. The current account, which includes the trade balance, measures all economic transactions with the rest of the world. A negative current account can signal economic weaknesses and potential crashes. For instance, the U.S. has experienced persistent trade deficits for decades. These deficits have contributed to rising national debt, making the economy vulnerable to external shocks. Thus, monitoring the trade balance and current account helps in understanding global economic relationships and potential risks. Section 8. International reserves, the economic safety net. International reserves are assets held by central banks in foreign currencies. They provide a cushion against economic shocks and help stabilize the national currency. Countries with large reserves are better equipped to handle economic crises. They can use reserves to support their currency and manage balance of payments issues. For example, China's substantial international reserves have helped it maintain economic stability during global downturns. These reserves act as a buffer against external shocks. Monitoring international reserves helps gauge a country's ability to withstand economic pressures. Low reserves can signal vulnerability to economic crises, while high reserves indicate strength. Section 9. Consumer and Business Confidence Indices, gauging sentiment. Consumer and business confidence indices measure the optimism or pessimism of households and companies about the economy. High confidence levels indicate positive expectations, while low levels signal concerns. These indices are leading indicators of economic activity. When confidence is high, consumers are more likely to spend, and businesses are more likely to invest. Conversely, low confidence can lead to reduced spending and investment. Before the 2008 crisis, consumer confidence indices began to fall, reflecting growing concerns about the economy. This decline was an early warning sign of the impending crash. Monitoring changes in confidence indices helps in understanding economic sentiment. Sharp declines in confidence can signal potential economic downturns and the need for policy interventions. Section 10. Summary: synthesizing economic indicators. Economic indicators provide crucial insights into the health of an economy. By monitoring these indicators, we can identify warning signs of potential crashes and take proactive measures. Gross domestic product, or GDP, reveals overall economic activity, while inflation and the Consumer Price Index, or CPI, show price stability. The unemployment rate indicates labor market health, and interest rates reflect central bank policies. Public debt and fiscal deficits highlight government borrowing, while the trade balance and current account show global economic relationships. International reserves act as a buffer against economic shocks, and confidence indices gauge economic sentiment. Together, these indicators form a comprehensive picture of economic health. By analyzing them collectively, we can better predict and respond to potential economic crises. Section 11. Conclusion: the value of vigilance. Monitoring economic indicators is essential for predicting and mitigating economic crashes. These indicators provide early warnings, allowing policymakers and investors to take informed actions. Understanding GDP, inflation, unemployment, interest rates, public debt, trade balances, international reserves, and confidence indices helps in assessing economic stability. By staying vigilant, we can better navigate economic challenges and avoid severe downturns. In conclusion, economic indicators are powerful tools for forecasting potential crises. Regularly tracking these measures enhances our ability to maintain economic stability and ensure sustainable growth. Brooks Data.